Hi and welcome to the Introduction to Financial Statements video series. In today's video, we'll be looking at the balance sheet. This series is created and narrated by Professor Elizabeth Keating and produced by Yasmin Mazen. We will be looking at the financial statements for a for-profit business, and occasionally we'll be commenting on what might be true in other types of organizations. The accounting rules used around the world are not entirely consistent, so today's video we're going to be focusing on the rules that are followed in the United States. What that means is we will be explaining the key financial statements as they are prepared according to the Generally Accepted Accounting Principles, or GAAP, as determined by a particular quasi-governmental organization known as the Financial Accounting Standards Board, or FASB for short. Before talking about the balance sheet in great detail, we'd like to provide an overview of the three key financial statements prepared by for-profit U.S. firms. The first is the balance sheet. The balance sheet is a statement that describes assets, liabilities, and equity at a particular point in time. The second key financial statement is called the income statement. This second statement describes revenues and expenses, and rather than it covering a point in time, it describes the revenue and expenses over a particular time period. The third financial statement is called the Statement of Cash Flows. It summarizes the cash movements of an organization by their purpose, and like in the income statement, it is the activity over a particular period of time. In today's video, we will focus on the first of the three financial statements, the balance sheet. We will look at it in detail. What you should know is the balance sheet is really the heart of the accounting system. The balance sheet is a snapshot. It's taken at one point in time. For example, it's often taken at the end of the year, at the end of December 31st. Okay, so imagine we've taken that snapshot. What that snapshot has done is it's figured out the dollar value of certain things belonging to the firm. For example, cash and their outstanding bills. We're going to categorize the balance sheet into three distinct groups. The first group are assets. These are items of value owned by the firm. The second category of items that belong to the firm are called liabilities. These are debts, financial obligations, and other claims, things that are owed to vendors, customers, or lenders. The third and final category of items belonging to the firm is equity. This is the funding provided by the owners of the firm. Now let's look at individual components of the balance sheet in detail. We're going to start with assets, and with the first asset, cash. Cash, people are relatively familiar with. This includes the balances that you have in the bank, petty cash, which might be amount sitting in a cash register or some other drawer like that. But we might also include as cash something we will call cash equivalents, which are certain types of banking instruments that can easily be turned into cash. The next asset that we're going to look at is called accounts receivable. If you think about the words receivable, it means that the firm is waiting to receive something from someone else. So accounts receivable is money owed by others to the firm. We're going to encounter a number of abbreviations in accounting, so here's our first one. Accounts receivable is also known as A/R. Within accounts receivable, There are several types of receivables. A very common type are trade receivables. These are receivables arising out of the normal everyday business or trade. So trade receivables is money owed by customers. They arise generally from two different types of activity. One is the sale of goods, and the other is the sale of services. So what are some other types of receivables that a firm might have? Three big categories are interest receivable, taxes receivable, and notes receivable. Interest receivable means that the firm is owed some interest. Taxes receivable means that the firm is expecting a refund of some taxes from a taxing authority. And finally, a note receivable means the firm is owed money, and that money that is owed is documented with a note. And generally it means that the firm will be receiving not only the principal amount of the note, but also some interest. Another important asset is inventory. These are the goods and materials that a business holds for the ultimate purpose of resale. Inventory can be broken down into different groupings. A common grouping are the three that are displayed here. The first group is raw materials. The second is work in progress, also called WIP, and the final one is finished goods. Sometimes when a company resells inventory, the inventory is simply called merchandise inventory. A less familiar type of asset is called prepaid expenses, displayed here by the sign, "Please pay first." With prepaid expenses, a firm is asked to pay in advance for something. For example, paying the last month's rent at the time that a contract is signed. Prepaid expenses, therefore, are future expenses that have been paid for in advance. Two common kinds of prepaid expenses are prepaid insurance and prepaid rent. We have now covered a group of assets: cash, accounts receivable, prepaid expenses, and inventory. All of these belong within a single classification, which is called current assets, or C/A. What is meant by current assets is that cash and other assets that are expected to be converted into unrestricted cash within the next year. Current assets is one category of assets. The other category of assets are long-lived or non-current assets. These are assets that are not likely to turn into unrestricted cash within the next year. Let's talk about several types. A common category of assets found in the long-term section are investments. These are ownership stakes in other types of ventures. Some types include stocks, which are equities in other firms, bonds, which are liabilities of other firms, and partnership interests. Some of these holdings are long-term, and we'll see it there in the long-term portion of the balance sheet, but occasionally we do see some investments listed in the current section. Another type of asset are called fixed assets. These are physical assets that are used in the business, including land, building, machineries, office equipment, vehicles, furniture, and fixtures. There are many others as well. What you should know about fixed assets is that unlike inventory, these are held by the firm and they're used to produce the things that the firm produces. These assets are not being held for sale. Fixed assets have many different names. F/A is one short way of depicting fixed assets. They're also called tangible assets, furniture and fixtures, or property, plant, and equipment. Property, plant, and equipment, it goes by a very common shortcut, PP&E. One last grouping of assets on the balance sheet, what we'll discuss in this video, are intangible assets. These are forms of intellectual property. These include many different things, such as patents, copyrights, trademarks, licenses, franchises, name brands, and goodwill. Some of these terms are not familiar to you right now, but will become more familiar throughout the accounting course. We're now going to move on and look at the second group of items owned by the firm. These are liabilities. If you remember, these are obligations or debts owed by the firm to other people, such as vendors and lenders. The first liability that we're going to look at is accounts payable, or A/P. These are amounts of money owed to the firm by others. Often, these are owed by vendors, that is, suppliers. Generally, accounts payable are documented with a physical invoice or bill. Just like accounts receivable, accounts payable come in different types. There's a type of accounts payable called trade payables. Just like trade receivables, these are ones arising from the course of normal business or trade. In the case of trade payables, this is money owed to the firm by suppliers. Other kinds of payables include interest payable, taxes payable, wages payable, and notes payable. All of these are amounts due to outside parties. So interest is interest due on different forms of debt. Taxes are due to taxing authority. Wages payable, or sometimes it's called compensation payable, are due to employees. And when a payable is documented with a physical piece of paper, a note, it's called a note payable, and it generally has interest that accrues on it, so that the firm would owe not only the principal, which is reflected in the note, but also interest. A second kind of liability are accrued expenses, also known as accrued liabilities. These are costs that are incurred and owed, but will be paid in the future. Unlike accounts payable, these costs are not documented by a written invoice from a third party. The amount that is owed under an accrued expense is kept track of or computed based on a time card or some other internal measurement system. Two examples of accrued expenses are accrued compensation and accrued interest. Firms often group accrued expenses together with accounts payable on the balance sheet. Another kind of liability is a deferred revenue, or D/R. It's also called an unearned revenue, U/R. What you can see with the little graphic is the stamp paid and coming soon. So what happens in the case of a deferred or unearned revenue is that the customer has already paid in advance for a good or a service that will be delivered later. A final type of liability that we might find in the current section is called short-term debt. Short-term debt is a catch-all term that's used to describe a wide range of financial debt that needs to be paid off within a year. For example, this could be credit card debt. It could be a bank loan that's due within a year, called short-term bank loans. Or it could be a piece of long-term debt, but just the piece that's due within the next 12 months. This is called current portion of long-term debt, or CPLTD for short. We've now looked at a number of different types of liabilities, all of which are current, meaning that they will come due or need to be paid off within the next 12 months. Current liabilities are often called for short, C/L. In this group, just to recap, it includes accounts payable, accrued expenses, short-term debt, and unearned revenue. Current liabilities are one category of liability. The other category are long-term or non-current liabilities. These are liabilities that are expected to last over 1 year. In the long-term liability section, we often find debt. It's often called long-term debt. The types of debt we're thinking about here are financial obligations, where there's principal that accrues interest. The firm is going to owe money to a variety of different outside parties. One type of long-term debt is bank loans, another are corporate bonds, and the final one that we often find are capital leases. We have now looked at two important groupings on the balance sheet. The first was assets, things of value that the firm owns, and the second are liabilities, which are obligations that the firm owns. These first two categories of items, assets and liabilities, are joined on the balance sheet by an important third category, equity. Those are the resources provided by the owners of the firm. There's an important mathematical relationship between these three items. It is that assets, the things that we own of value, equal liabilities plus equity. What does that mean? What it means is that all the things that we own of value must be paid for either by other people's money, in other words, the liabilities or debt provided, or by the resources provided by the owners of the firm. What exactly do we mean by equity? We're going to look at two different types. The first is the acorn. That's the startup capital, what we start with. So initially an investor contributes the acorn into the firm, and that is often called contributed capital or paid-in capital. When we start learning how to do the details of accounting, we'll actually see contributed or paid-in capital are divided into two categories on the balance sheet. One of them is called common stock, and the other is called additional paid-in capital, or APIC. If a firm is successful, that initial acorn of an investment will grow and create profits for the firm. Those profits can be kept by the firm in order to supplement their equity. The second type of equity is known as retained earnings. Some firms will decide that they don't want to keep all of their profits and will return some of them to their investors in the form of dividends. When they do that, it will cause retained earnings to decline. Okay, so we've now covered the balance sheet. It describes the assets, those things of value owned by the firm, and then how it can afford to pay for them, either with liabilities, that is the use of other people's money, or with equity, which are the resources provided by the owners. Those resources include both the initial investment and the retained earnings. Before we end the video, let's consider for a minute other possibilities for that last category, the equity category. Remember that it represents the difference between all of the assets, which are known as total assets, or T/A, and total liabilities, known as T/L. We then call that remaining category, most of the time, total equity, or T/E. Total equity, however, can be called many different things. If a firm is actually a sole proprietor, meaning it's owned by one individual and it's not incorporated, then the equity section is called owner's equity. When that contribution is made by a group of people in the form of a partnership, rather than an incorporated entity, it's called partner's capital or equity. In the course of this course, we'll be mainly looking at situations where we're looking at an incorporated for-profit entity, in which case this section will be called shareholders' equity. We may also see a few examples of nonprofit organizations who will call this component of the balance sheet net assets, meaning total assets minus total liabilities leaves us a net amount of assets. And then finally, we'll see the term fund balance being used by governmental organizations and a few nonprofits. As I have mentioned, not all equity is created equal. So sole proprietors and partnerships have unlimited liability, whereas a corporation has limited liability. In other words, the shareholders only will ever lose the amount they contributed and the retained earnings. But the corporation and the shareholders have a different burden, and that's double taxation. Both the corporation and the shareholders need to pay income taxes.
Now I'd like to discuss what a balance sheet in good form looks like. You'll see highlighted here with 2 arrows the name of the company we're looking at, the Procter & Gamble company, and the name of the schedule, the kind of information that's being presented. You'll see highlighted the consolidated balance sheet. So 2 of the 3 pieces of information that you need to provide is the name of the company and the kind of information being presented. Other information that's also necessary is the time period involved. A balance sheet is a snapshot at a point in time. So you could see years ended June 30th, 2015 and 2014. Note that the year 2015, which is the most current year, is being depicted on the left, and then after that, the old year, 2014, on the right. This is a very common convention, but often leads students to be confused about a trend or a direction, as they often expect the old year to be presented first, and then the new year. Another attribute you'll see being presented at the top is the amount, amounts in millions. If that is not stated, one is to assume the amounts are in single numbers. The dollar sign, which is circled here, indicates that the currency being presented is in dollars. Therefore, the schedule is amounts in millions of dollars. You'll see dollars depicted at the top of a column of numbers and then at the very bottom where there's a subtotal. You can now see 2 arrows being shown, a red one and a blue one. Throughout this presentation, the items highlighted in red are required information. So you'll see that total assets are being presented at the very bottom as a required total, and in fact it's a grand total being denoted with a double underscore. You'll also see a blue arrow associated with total inventories. You can see that inventories here are broken down into materials and supplies, work in process, and finished goods. This is a required breakdown, but firms can elect whether to show this breakdown within the balance sheet or separately a few pages later in the footnotes. We can now see in front of us a tan arrow highlighting total current assets. When we have what's called a classified balance sheet, we will break down the assets and similarly the liabilities into whether they are expected to be present on the balance sheet 1 year from today. Anything that is expected as an asset to turn into cash within the next year needs to be in the current asset section and on a proper classified balance sheet, which is what is required for a publicly traded firm. One will have to have this particular total for total current assets. If you look on the line below that, you can see property, plant, and equipment, comma net, in bold. This is trying to denote this is an important asset and that it actually is composed of a number of subassets and subcategories. We don't see those subcategories depicted here on the balance sheet. Instead, if we go a few pages later, we'll see a schedule where that breakdown will be provided. Now we're going to move to the other side of the balance sheet equation, to the liabilities plus shareholders' equity. What I did in the prior slides was to give you a snapshot of the top half of the page that presented the schedule, the consolidated balance sheet. I'm now depicting the bottom half of the page. So you can see intermediate title here being presented of liabilities and shareholders' equity being highlighted with the red arrow. And you can see that the dollar signs are being reintroduced. They're being reintroduced because we had a grand total of total assets. And now in this new section, we're going to be starting and counting up a brand new total, which that brand new total at the bottom of the page will be total liabilities plus shareholders' equity. Now we'll look at some of the required subtotals. We'll see in red at the bottom of the page total shareholders' equity, and we'll see there were quite a number of accounts that went into that required total. Now you'll see in blue a total for total liabilities. You might puzzle about that. Shouldn't it be required that it's total liabilities? Shouldn't that arrow be red rather than blue? There's actually some historical reasons for it, but total liabilities, that subtotal, it is optional whether you present it or not. And now finally, in tan, we're going to be highlighting the total current liabilities subtotal. Just like with assets, liabilities need to be divided based on whether they're expected to be on the balance sheet 1 year from the balance sheet date. In this case, we can see there are 4 categories of total current liabilities, and then below that presented are various liabilities that we will call non-current or long-term that we expect to be on the balance sheet a year from today. You'll note in the shareholders' equity section, there is no division between current and non-current equity.
We hope that you've enjoyed this first Introduction to Financial Statements video. We've covered the balance sheet. In the next video, we'll be looking at the 2 other key financial statements, the income statement and the cash flow statement.